Moody's lowered the U.S. credit rating last week, and there are some concerns about what that might mean for the housing market. I'll tell you exactly what to expect next. So if you get some value out of this, you like what you hear, make sure to subscribe to the channel, hit the bell for notifications, and if you want to schedule a call with our team to talk about how this Moody's downgrade may or may not affect your real estate plans, you can do that with the link in the comments. Last week, May 16th, Moody's lowered the U.S. credit rating from AAA to AA1, pointing to a rising national debt and some higher interest costs, and that sparked some concerns about what that might mean for housing. Is this going to increase borrowing costs? Is this going to increase mortgage rates? And there's a lot of things to unpack here. One, the U.S. and the government has already requested an increase to the debt ceiling, which happens every once in a while, and it's a result of inflation. Well, we've seen inflation is stabilized. It's closer to the Federal Reserve's 2% target. So this is a thing that happens not regularly, but it's not uncommon when budgets are being balanced in Washington. And the market could react strongly here. Mortgage rates could jump up a little bit, maybe to north of 7%. Last week we were seeing 6.95, 7.125% in terms of 30-year fixed rates being quoted to our clients. So it could cause rates to creep up a little bit and making those monthly payments more expensive. That's definitely an outcome here that could happen. However, history shows that downgrades like this often have very limited long-term impact. After a similar downgrade in 2023, as an example, as a case study, rates fluctuated, but then ultimately stabilized as the economy adapted to the Moody's downgrade. So what this really tells me is that this is important. You want to watch this stuff. You want to be very cognizant of these Moody's rankings, but the market we're in isn't going to be that different than the market we're going to see the next 3, 6, 12 months, because the predictions are, if anything, rates may go down a little bit. All the predictors out there have estimated mortgage rates are going to be in the 6.34% range. That's based on 27 different predictions and the average. So being today we're close to 7%, just below that, that would probably be a welcome development for a lot of home buyers. What we also know, there's a lot of demand in the housing market right now. We've seen inventory increase to the highest level since pre-pandemic, meaning we're at 30% more homes that were on the market compared to last year. And what we know is that this is the most amount of homes that we've seen for sale since 2019. Locally in the greater Philadelphia area, inventory and active listings, same thing, they're up 18.2%. So there's more options out there, which was a big complaint for a lot of consumers in the marketplace. We're seeing the demand's very strong, and that's going to fluctuate from neighbor to neighborhood. So this news from Moody's maybe has a quick short-term impact on mortgage rates, but I doubt it's going to change anything moving forward. So what we know is if you're thinking about selling a home, you want to look at what's your competition like, who's on the market around you, where are home sales locally trending, what sort of demand are we seeing, what sort of days on market are we seeing for your neighborhood and your segment of the market. That's number one. And remember, the best time for a seller to be on the market is when the neighbors aren't. We also know that seasonally, we see about 60% of our business get booked between January 1st and June 30th each year in the greater Philadelphia area, meaning an agreement of sale is signed. So we're right in that season where there's a lot of folks that are going to be transacting. So if I'm a seller, I'd be more concerned about missing the seasonal market than anything else if I'm not on the market yet. Now, sometimes these sellers and home sellers in general, they've got to have a place to go to. So it's not about timing the market. And if you're wondering what the ideal time is to jump into the market as a home buyer, it's very simple. It's the magic formula. We talked about it last week on the show here, which is it the right house for you and your household? Meaning, does the house work? Can you afford the monthly payment? And do you plan on being there for the next 5 years? And if the answers are yes to all three of those, then you're making a great real estate decision. Barbara Corcoran just came out and talked about how she felt like she overpaid for every single home that she's bought. And looking back on it, she didn't. She paid a fair price. There's the quote we're going to put up here. It's a little different than what I'm sharing, but I want to interpret it for you. that she felt like she overpaid for every single home, but it was the right move for her family. It was the right move for her household, and she was really happy with it. And that's really what you want to focus on as a home buyer or someone that's a home seller with a place to go. Those are really the questions you want to ask yourself right now. Don't let this headline, like Moody's downgrading U.S. credit, affect you, because it doesn't look like historically it's going to have a huge impact on borrowing costs or mortgages. It's just something you want to be informed about. And the best thing to do as a consumer is get clear on what are the market conditions, what are my actual real estate goals, what am I trying to accomplish, what's the current process look like right now, and what's the financial environment and the lending environment look like. And that's what a great professional is going to break down for you. So if you feel like you need that information, I've got an easy solution for you. Down below, click on the link in the comments, and you can schedule a call with our team, and we'll help you do exactly that.